When the central bank raises interest rates, it makes headlines. It has the potential to send ripples across the entire economy. This can have devastating effects on consumer confidence, the loss of jobs, and lower wages, and it can also cause a drop in stock prices. An economy will be thrown into recession if they go too far too fast. But then, why do central banks raise interest rates? Hello and welcome to the Finance Guardian channel. In this video, we'll answer one puzzling question. How does raising interest rates bring down inflation? So hit that subscribe button and the bell beside it, and let's get started. First of all, if you are unfamiliar with what inflation is a rise in prices which can be translated as the decline of purchasing power over time. It's easy to see how purchasing power drops by looking at the average price increase of some goods and services. Price increases, which are usually expressed as percentages, mean that a currency unit buys less than it did in prior periods. The opposite of inflation is deflation, when prices go down and purchasing power goes up. In July 2022, the Consumer Price Index measured inflation in the United States as 8.5%. This means that the cost of goods increased by an average of 8.5% in the past year. Inflation affected not all goods and services equally, but food and energy saw the biggest jumps. Many different factors contributed to the price spikes across the board. Energy prices skyrocketed due to the war in Ukraine, while supply chain shortages affected the prices of other goods, such as cars. That's right, high prices are caused by insufficient supply and too much demand for goods and services simultaneously. That's where the Federal Reserve System comes in. It controls interest rates, or the federal funds rate, to make sure inflation and unemployment in the US stay low. The Fed hopes to slow down the economy and bring prices down by raising interest rates. But exactly how does raising interest rates do that? Rates go up and demand goes down. The Federal Reserve controls the federal funds rate, often referred to as the target rate. Basically, this is the rate of interest that banks use to make overnight loans to one another. If you thought that individuals were the only ones borrowing money from others or banks, you got it all wrong. It is also common for banks to borrow money from each other to provide loans to consumers and businesses. Therefore, if the Fed raises its target rate, banks that need funds to lend or meet regulatory requirements will have to pay more for borrowing. This higher cost is naturally passed on by banks to consumers and businesses. Thus, if the Federal Reserve increases its target rate by 25 basis points or 0.25 percentage points, consumers and businesses will also be required to pay more for borrowing money. Just how much more will vary significantly based on many factors, including how long the loan is maturing and how much profit the bank wishes to earn. As a result, higher borrowing costs dampen demand and economic activity. For example, if a car loan gets more expensive, you might think now isn't the right time to buy that brand new convertible or pickup truck you've been eyeing. Or it might be less likely for a business to invest in a new factory and hire more workers if interest rates on loans to finance it rise. This is what happens to the economy when the Fed raises interest rates. But inflation goes down with reduced demand. Interestingly, this is also one of the factors that slow the pace of inflation. The price of goods and services usually goes up when the demand is high, but when borrowing gets more expensive, demand drops for goods and services throughout the economy. Prices may not necessarily go down, but inflation will usually slow down. We can illustrate this by considering a used car dealership, whose inflation has been exceptionally high throughout the pandemic. Assume for now that the dealership has fixed inventory of 100 cars. Demand will drop when the cost of buying one of those cars shoots up because the interest rate on loans needed to finance it increases. This is because fewer people will be able to afford it and show up on the lot. For the dealer to sell more cars, he'll probably have to cut prices. Besides that, the dealer faces higher borrowing costs, not to mention tighter profit margins after lowering prices. So perhaps it can hire all the workers it planned to, or even has to lay off some. This might reduce demand for cars even further since fewer people can afford down payments. Now, imagine that it's not just one dealer seeing demand drop, but the entire US $24 trillion economy. It doesn't matter how small a rate increase is. It can have ripple effects and slow down economic activity, making it harder for companies to raise prices. Raising rates too quickly has its risks. Take note that in our previous example, we assumed a fixed supply. But in recent months, we've seen that the global economy has been dealing with supply chain disruptions and shortages. The impact of these problems has been felt throughout the world, resulting in increased production costs. The Fed will have to raise interest rates significantly if US inflation is mainly caused by these higher production costs and low inventories. And the higher and faster the Fed will have to raise rates, the greater the harm to the economy. Keeping our car example in mind, a critical input to cars these days is computer chips. Suppose the cost of computer chips rises sharply due to a new pandemic-related lockdown in Asia. In that case, car makers will have to pass on these higher prices to consumers as an increase in car prices, regardless of interest rates. If this occurs, the Fed may have to dramatically raise interest rates and significantly reduce demand to slow down inflation. It is unknown how high interest rates may need to rise to stabilize inflation around 2%. So is raising interest rates actually effective? The chairman of the Federal Reserve, Jerome Powell, has stated that he is working towards aligning demand more with supply. However, the global supply chain for a wide range of products has suffered significant constraints throughout the pandemic due to strict policies governing COVID-19 in China, where many mass-produced goods are produced. The ongoing war in Ukraine has negatively affected global food supplies and crude oil and natural gas resources that Europe relies on a lot. In other words, the Fed may only be able to do so much with its available tools. Now, there's nothing wrong with a bit of inflation. It keeps the economy moving at a reasonable speed. But inflation that stays too high for too long isn't good. Higher prices mean people need higher wages, which means businesses have to pay more. That could drive up prices further, leading to an upward spiral of wages and prices. Take India, for instance. Retail inflation in India has surged 7.4%. This, combined with tepid economic activity, presents severe challenges for the Indian economy. Setting inflation expectations is really important to central bankers. The idea is that if it can prove itself credible, it will always act to get inflation back down to 2%. Then maybe it doesn't have to raise interest rates and then lower them back and forth in this kind of seesaw pattern. A rise in interest rates can slow an economy right down. The trouble is the brake pedal has a delay. It can take up to 2 years to see the full results of interest rate changes. The central banks know this. So when they set interest rates, they're attempting to read the road ahead. But predicting the future is not easy. It's difficult for the central bank to determine whether inflation will fall back on its own, and despite getting it right, central banks might still cause a crash. Raising interest rates is still central banks' primary tool for taming inflation, even though it is a blunt instrument. A central banker will say that, yes, raising interest rates can be painful, slowing the economy might not be fun, but it is worth it. It's worth it to achieve low and steady inflation in the long run. So you don't have to worry about it. And that's all the time that we have today, folks. What do you think about raising interest rates to bring down inflation? Do you think it's a good idea? Let us know in the comments down below. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.